Silver just crossed $90 an ounce. Let that sink in for a moment. Not 30, not 50, not even 85, which every single mainstream analyst called impossible just 60 days ago, $90. And right now, there are two types of people watching this video. The first type already holds physical silver. They are calm. They are not checking their phone every 5 minutes. They saw this coming because they followed the data. The second type is panicking right now, asking themselves, did I miss it? Is it too late? Should I buy at 90? Should I wait for a dip? By the end of this video, you will know exactly what happens next to silver. Not based on emotion, not based on YouTube hype, based on cold, hard, verifiable data. My name is Stack AG, and this is where logic meets precious metals. Before we talk about where silver goes from here, we need to understand exactly how we arrived at $90, because this move did not happen overnight. This was building for months, and if you understand the three drivers behind this rally, you will understand why what comes next is so important. Driver number one, industrial demand. This is the one that Wall Street kept ignoring. Silver is not just a monetary metal anymore, it is a critical industrial input. Every single solar panel manufactured today requires silver. Every electric vehicle battery, every semiconductor, every AI data center running on advanced chips. The demand coming from these industries in 2024 and 2025 has been unlike anything recorded in the past 30 years. The Silver Institute's data shows industrial demand hit record levels, and it is still accelerating. Industrial silver demand bar chart 2020 to 2025. Driver number two, COMEX vault drainage. For those who are new to this channel, COMEX is the primary futures exchange where silver contracts are traded in the United States. And attached to COMEX are physical vaults where registered silver is stored. Silver that is available for delivery against futures contracts. We have been tracking these vault numbers every single week, and what we have seen is alarming. Registered silver inventories have been falling consistently. Month after month, millions of ounces have been leaving these vaults. When the physical silver backing the paper market starts disappearing, it creates a pressure that the price must eventually reflect. COMEX registered silver inventory chart. Declining trend. Driver number three, dollar weakness. The Federal Reserve's signal toward rate cuts changed everything for precious metals. A weaker dollar makes silver, which is priced in dollars globally, cheaper for every other currency in the world. Chinese buyers, Indian buyers, European buyers, they all get more silver for their money when the dollar falls. And that additional buying pressure from the rest of the world piles on top of already record industrial demand. Three drivers, all pointing in the same direction, all hitting at the same time. $90 silver was not a prediction, it was mathematics. Now, the question that brought you to this video, what happens next? I'm going to give you three honest scenarios, the bull case, the consolidation case, and the bear case. And then I'm going to tell you, based on current data, which one I believe is most probable right now. Scenario one, the bull case. Look at the gold-silver ratio. Right now it sits at approximately 75 to 1. That means it takes 75 ounces of silver to buy 1 ounce of gold. Historically, and I mean going back 100 years of data, this ratio has averaged closer to 47 to 1. In 2011, during the last major silver bull market, it compressed all the way down to 32 to 1. Gold is currently trading above $3,200 per ounce. If the gold-silver ratio simply returns to its long-term average of 47 to 1, silver's mathematically fair value at current gold prices is $68. We are already past that. If the ratio compresses to 40 to 1, fair value is $80, already past that too. If it goes to 35 to 1, like it did briefly in 2011, fair value is $91. And if we see a genuine supply crisis, which the COMEX data is beginning to suggest, ratios below 30 are not impossible. At 30 to 1 with gold at $3,200, silver should be above $106 per ounce. Bull case price target, $115 to $130 within 6 months, assuming industrial demand holds and COMEX vault drainage continues at the current pace. Scenario 2, the consolidation case. Markets never move in straight lines, not gold, not stocks, not real estate, and definitely not silver. After a move this aggressive, from $24 to $90 in under 12 months, a period of consolidation is not just possible. It is healthy, it is normal, and frankly, for long-term stackers, it is welcome. What does consolidation look like? Silver trades sideways. It bounces between $80 and $95. Maybe it dips to 78 and scares everyone. Headlines come out saying the silver rally is over. YouTube channels start posting crash videos. Reddit gets bearish. And then, quietly, the same fundamentals that drove silver to $90 are still there. Industrial demand did not disappear. COMEX vaults did not suddenly refill overnight. The dollar did not magically strengthen back to 2022 levels, so smart money uses the consolidation to accumulate more. Weak hands sell at a small loss, and the next leg, higher, begins, this time with even more conviction. Example consolidation pattern from 2010, silver chart before the 2011 explosion. Consolidation case, silver trades between $78 and $95 for 4 to 8 weeks, then resumes higher. This scenario requires no new negative catalyst, just normal market digestion after a historic run. Scenario 3, the bear case. I am going to be completely honest with you here, because unlike most channels, we do not just tell you what you want to hear. We tell you what the data says, even when that data is uncomfortable. Could silver drop sharply from $90? Yes, absolutely yes. Here is what would need to happen. First, the Federal Reserve would need to reverse course completely and signal aggressive rate hikes. Not just pause cuts, actually hike. That would strengthen the dollar rapidly and hit silver hard. Second, a major global recession would need to hit industrial demand simultaneously. If factories slow down, if EV adoption stalls, if solar panel installations drop, the industrial demand pillar disappears. Third, COMEX vaults would need to somehow refill. New supply would need to come to market fast, either from miners ramping up production dramatically, or from large holders deciding to dump physical silver back into the registered inventory system. Show graphic. Bear case scenario chart. Silver dropping to $65 at $1.70. If all three of those things happen at the same time, bear case target is $65 to $70 per ounce. That is a $20 drop from current levels. That would hurt. But here's the critical point. Each one of those three things happening is unlikely on its own right now. All three happening simultaneously, the probability is very low based on current macro conditions. The bear case is possible. It is not probable. Now, let me show you something that most retail investors never look at, but every serious silver analyst watches every single week. The CFTC Commitment of Traders Report, COT for short. This is completely public data, published every Friday by the Commodity Futures Trading Commission. It shows you exactly how different categories of traders are positioned in the silver futures market. Large speculators, commercial traders, managed money funds. And right now, managed money, meaning the large hedge funds, have been increasing their net long positions in silver futures for 8 consecutive weeks. 8 weeks in a row. They did not buy once and stop. They kept buying, week after week. That is not a trade. That is a conviction. Meanwhile, we'll look at what is happening in Shanghai. The Shanghai Gold Exchange, SGE, has been consistently showing silver premiums above the COMEX benchmark price. Chinese buyers are paying more than the global market price just to get their hands on physical silver. When a buyer voluntarily pays above market price, it means they cannot find enough supply at market price. That is a physical shortage signal, not a paper shortage, a real physical shortage. And here's the part that gets very interesting. Central banks globally have been accelerating their gold purchases for 3 consecutive years. The narrative has been all about gold, but quietly, strategic metal reserve policies in multiple countries are beginning to include silver alongside gold for the first time in decades. This is not public. It does not make headlines. But it is showing up in the flow data. Smart money is long silver. Smart money is accumulating physical. Smart money is not selling at $90. The only question is, are you thinking like smart money right now? Or are you still watching from the sidelines, waiting for silver to come back down to $50? Okay, practical time. What should you actually do with everything I just shared? Before I answer that, mandatory disclaimer. I am not a financial advisor. Nothing in this video is financial advice. Everything here is my analysis based on publicly available data. Your financial decisions are your responsibility. Always consult a qualified professional before making investment decisions. Now, with that said, here's how I think about it logically. If you already hold physical silver, the data supports your thesis. Do not let short-term volatility shake you out of a long-term position. Consolidations feel painful when you're living through them, but the fundamentals that got silver to $90 have not changed. If you hold paper silver, ETFs, futures, mining stocks, understand that paper and physical are 2 different things. Physical silver in your hand cannot go to 0. Paper can. Know what you own. If you have 0 silver exposure and you are watching this at $90, I understand the psychological difficulty. Buying at 90 when you watch silver at 30 feels painful. But the relevant question is not where silver was. The relevant question is where silver is going. If the bull case plays out toward $120, then 90 was an excellent entry. Emotion says, wait for a dip. Logic says, evaluate the fundamentals. If you are completely new and have never bought silver before, start small. Dollar cost average. Do not put your entire position in at one price point. Buy a small amount now. Buy again next month. Build a position over 3 to 6 months. Remove the emotional pressure of trying to time the perfect entry. And one final thing, and I say this on every single video because it matters. We do not sell anything on this channel. Not silver, not gold, not courses, not memberships, nothing. If anyone contacts you claiming to be Stack AG in the comments, in your DMs, on WhatsApp, anywhere, trying to sell you silver or investment opportunities, they are a scammer. Block them immediately. Report them. Do not send money to anyone claiming to represent this channel. We are here to educate. That is it. Silver at $90 is not the end of this story. It is the moment where most people finally start paying attention. The investors who will benefit most from what comes next are not the ones who buy in a panic today. They are the ones who understood the fundamentals 6 months ago and had the patience and conviction to hold through every dip, every scary headline, every moment of doubt. That is what this channel is built for. Not to hype you into buying, not to scare you into selling, but to give you the data, the context, and the logical framework to make your own informed decisions. Every day, consistently, without agenda. If this video gave you value, subscribe, hit the bell notification, because the silver market is moving fast right now. And when the next major development happens, whether that is a COMEX default signal, a Fed announcement, or a Shanghai supply alert, you want to know about it the moment we publish. Share this video with one person in your life who needs to understand what is happening in the silver market right now. One person. That is all I ask. I am Stack AG. Invest with logic, not hype. See you in the next one.